In our prior lesson, we learned the introduction element where we saw a derivative being a contract, and a contract in which it derives its value from another asset. This other asset, we are calling it what? An underlying. This underlying can be a bond, can be a share, can be a currency, or a commodity. We have seen the introduction bits of the types of the types of derivative instruments. They were one, the forward commitments. In the forward commitments, we have looked at two. One was the futures contract, and the forward contracts. In the forward contract, we have seen they trade under the OTC, unregulated and private engagements market. And then we have seen the futures trade under what? The stock, the securities exchange. They are public transactions. They have lesser risk because of the process we call marking to market. Today, we are still on introduction to derivative market. Markets and instruments. Yeah, we have seen the types of derivatives. We're on the topic types of derivatives. The types of derivatives, we have seen forward commitments, and in forward commitments we have seen of three types. We have seen the futures, we have seen the forwards, and we have seen the swaps. The second type are called contingent claims. In contingent claims, we are talking about what? Options. And then we have hybrid instruments. In hybrid instruments, we have an example to deal with, for example, swaptions. Let us look what we call contingent claims. Contingent claims are derivatives in which the payoffs occur if a specific event happens. So what are contingent claims? We are saying that they are derivatives in which the payoffs occur if a specific event happens. Payoffs occur if a specific event happens. What do we mean by this? We refer generally to them by the name option. An option is a financial instrument in which gives one party the right but not the obligation to buy or sell an underlying asset from another party at a fixed price over a specific period. So we generally refer to them as options. And how do options behave? They give the right but not what? The obligation. But not the obligation. And when you have the right to do what? To buy or sell. The right to buy, yeah, or sell. The right to buy is called the right to buy. Right to buy is called call. Call. Such that if you have the right to buy, we'll say we have what? A call option. Then the right to sell here we have what? The put option. So we are saying the call option gives the holder the right to buy a what? A financial asset at a future date with a price agreed what? Upon today of a specific time. So we are saying this, the future price is agreed today. Future price is agreed at the start. At the start. At the start of the contract, we are saying is what? Today. Over what? Over a period, over a specified period of time. Specified period of time. That is what options are. An option that gives the right to buy is referred to as a call. An option that gives the right to sell is referred to as a put. The action of buying or selling is called exercising the option. So what is this action? When you say you are now want to exercise this right, so exercising the option. This is executing the right. You are executing the right. So when I say we are exercising the call option, I'm saying you are what? Deciding to buy. When I say you are exercising the put option, you have made the decision what? To sell. And when you execute, at what price do you execute? It is called the exercise price. Exercise price. Yeah. So the action of buying or selling the underlying asset is exercising the option at what? The exercise price. So the holder who has the right to exercise will only do so if it is advantageous. Otherwise, the option will expire unexercised. We say that in contingent claims, they depend on a particular what? The payoffs depend on a specific event happenings. If you want to buy, and this contract that you have signed, you say you are going to buy maybe the KCB share at 50. When the market conditions are that the KCB share is selling maybe for 48 shillings. Of course, no one would like to buy at the expensive price of 50, would like to buy at 48. So therefore, you will not what? Exercise the option, you let it expire. Or put it the other way. If the KCB share is selling at 50 and the contract is what? Stipulating that you will sell. You have the option to sell at 48. Of course, you cannot sell at the raw price when the market is offering what? 50. Therefore, you let the option expire. So the payoff, that's why we are saying it's a contingent claim. To acquire the rights, how do you acquire these rights? To acquire the right, the buyer of the option must pay a price at the start of the contract. And this price is called what? The option price or the option premium. At the start of the contract,